So Nicholas Bornoz of Capital Inc. And I'm again delighted to welcome you to another terrific panel at our forum on the product tanker sector. So just before coming on board, everybody was saying, hey, Nicholas, you always say that it's a terrific panel and it's a great panel. And I was saying, but you know, this is the truth, because on one hand, we put together relevant content. And on the other hand, I'm gratified to have industry leaders like we have now. So when you have the right topics and the right people, who's not going to come and listen? So I would like to extend a huge thank you to all of you for being part of this panel. And I will turn it over to Jim Cirenza from DNB Markets, our partner in today's event. So Ted, the floor is yours. I will let you introduce our speakers who need no introduction, but nevertheless, the floor is yours. And thank you again.
Good afternoon, and my thanks to my panel today. We've got Eddie Valentis, founder, chairman, CEO of Pyxis. We've got Carlos D. Mottola, CEO and board member of D'Amico. Michael Skov, who you'll recognize by the really fancy tie, CEO of Hafnia. Tony Gurnee, CEO of Ardmore, and Jacob Meldgaard, CEO of TORM. Before we get going, just to paint a picture, and I think it's always easier to look at graphs and look at pictures to save a few words, could you put the slides up, please? All right, so the slide on the left is vehicle traffic in the US relative to where we were in 2019. Truck traffic is up 10%, passenger vehicles down 10%. The chart on the right are global petroleum inventories. So after an all-time high in April and May of last year, globally, we're back down to where we were pre-pandemic levels. Could you put up the next slides, please? All right, so the slide to the upper left-hand side, focusing on the US because we get the US data earlier than we get out of most parts of the world. 2020, as we reflected on a minute ago, we saw the all-time highs in terms of petroleum inventories. I'm not going to break down all the different product classes for you. And you can see where we are in the US now with that dark green line, where we're clearly below the range and we're clearly below the 5-year average. If you go to the slide directly below that, you see the US refinery crude runs. And so after being in incredibly low levels last year, in the 70s at the start of this year, we reached north of 90% refinery utilization at the beginning of the summer. So June, July, August, very steady. September, not so steady, but hurricanes and weather had something to do with that. And we've just recently crossed over above the 5-year average in terms of refinery runs. And if we look at flights, there are two charts left. One is the US passenger miles, not miles, but US passenger volume, and the other one is global commercial flights. Both are about 20% below our 2019 peak. If you adjust for the improvement in domestic relative to international flights, maybe total airline miles are down 25% from their peak. But obviously the seasons will soon change, but I think that just gives you a little bit of a context as we get the conversation started. So to begin with, global energy inventories clearly went from all-time highs in 2020 to below the 5-year average now. As we head into the winter season, how do you think about how this will impact the world? And how do you think about it in terms of how it'll impact your sector? And why don't we start with Jacob on that?
Yeah, thanks, Jim. Well, as you just pointed to, if we look at the recovery in consumption, clearly our sector and the world at large is on the right track. What has sort of blocked a real fundamental step change in our market is that every day since June of 2020, demand has been higher than the actual production in sort of the ecosystem. And if we look back, for instance, at August, where there you were drawing on a daily basis inventory at the rate of 2.7 million barrels per day. So that's about 3% of the daily consumption is actually taking out of exactly, as you pointed to, the inventories that were built in Q1, Q2 of 2020. So that means that currently we are transporting less than what is actually the actual fundamental demand in the economy. And obviously, that as long as that takes place, we have a headwind in that the economy is recovering, but transportation need is lower than what is actually there. In our opinion, this is, for various reasons, obviously not the sustainable new normal. What will happen is that eventually stocks and inventories will be down to a level where you will need to rebuild stocks, and where at the same time the economy and the underlying fundamental oil demand is still on a trajectory of recovery, whether be it, as you pointed to, in the airline industry coming back to more normality also on long-haul routes. So I think it's a question of timing, and none of us are really masters of the exact timing, but clearly to turn this now more than 18 months of that we've seen that consumption on a daily basis is healthy, improving, but that actually the production is lacking because of the inventories that we had. So once we have more pain currently in the spot market for both crude tankers and product tankers, and I think that will persist until you see that this curve of depleting inventories is going to turn, and it will obviously turn at some stage.
Carlos, I'm going to ask you the same question, but I'm just going to highlight a couple of additional things. So 2019 was the greatest expansion in refinery capacity globally in over 40 years. Obviously, January 2020 ended up being not quite even an entire month of celebration. Touch base a little bit on how much of the product touches the water, and if we get to an environment where inventories need to catch up during a winter season, what that could mean from a disruption point of view, and what that could mean for the product tanker segment as potentially a larger percentage touches the water. Carlos?
Jim, yeah, thank you for the question, and I think that what Jakob highlighted regarding the inventories is definitely key, and we are seeing that in other energy markets right now, and the risks associated with inventories running too low, as is happening now for coal, and to a lesser extent, but also in the gas markets. And I think that this is going to be key also, hopefully, for our market this winter. I think that there is a huge pent-up demand associated with the energy crunch that we are experiencing right now worldwide, which is going to be probably exacerbated over this winter. There are rumors of huge orders being placed in China for diesel generators. I'm sure it's not only in China, in other locations, to guarantee electricity for industry. And a report from a renowned brokerage house highlights that there is a potential for use of oil in its various forms for production of electricity of around 20 million barrels per day, mostly in Asia and the Middle East, of which only 3 million barrels per day are used. Of course, these are huge figures. Only a few million barrels per day would make a huge difference. And as you pointed out, the refined product industry is usually transporting between 22 and 23 million barrels per day only by sea, relative to oil consumptions, which are pre-COVID almost at 100 million barrels per day, and refinery throughputs, which are around 80 million barrels per day. So it's a small portion, and 1 to 2 million barrels per day can make a huge difference in the demand for our vessels and for our sector. So that is definitely an element of hope for us. And of course, there is an ongoing ramp up in production by OPEC, which means that there's more product to be refined. And nonetheless, the markets continues to be undersupplied, and there are inventory drawdowns. So OPEC might have to react and supply more. We are seeing that the U.S. shale industry is reacting slowly, but the drilling rigs are increasing, and I guess once this excess supply of OPEC has been fully reabsorbed, they will react more forcefully, and the U.S. shale production will also be a driver, hopefully in 2022, of increased oil supply and increased refined products moving by sea.
Eddie, I'm going to start with you on this next question. November air traffic restrictions will be reduced. Is this the next big potential trigger for the product space?
Thank you for the question, Jim. Greater mobility will be helpful. Let's face it, transportation fuels is a substantial part of the cargoes we're carrying. Now, specifically for airlines, the jet fuel, as you said, demand consumption is 25 to 30% lower than pre-pandemic levels. Therefore, any addition in mobility, any addition in transportation will help. Of course, jet fuel is only approximately 10% of the cargoes we're carrying. Therefore, what we see as the, let's say, the main driver coming in the next months is what my predecessors have said. Mainly we've seen a spike in the heating oils, and we've seen a spike in LNG, LPG, even coal. So this is where we expect the next big thing in products to come, the seasonal demand for winter for heating oil. So we expect a robust demand, especially as inventories are coming down, for fuel oil, gas oil, diesel, and naphtha. In the longer term, and as vaccination is accelerating, and the global economic recovery is also accelerating, this should result in greater demand for refined products and, of course, improved charter rates.
Mikael, I'm going to ask you the same question, looking at near-term likely reduction of restrictions of air travel.
Yeah, so thanks for that. I think most have been said kind of around what we expect of getting into this season. But I think what's worthwhile to mention here is that, jet fuel, of course, is one. And I think we're all seeing as restrictions are being easing, of course, it will help. But I think another add-on here is that, as Jacob explained, in terms of inventories coming down, when the market has set itself up for where we are now, which means that any form of extra demand will be sourced on a much more prompt basis than before. And what that basically means is that if you're short of a refined product, which is really a finished product, you're going to have to try to get it from wherever. It's not a long-term process. It's about trying to get something here and now. And what that always means for our market is longer ton mile. So you're kind of looking at an arbitrage volatility in prices and longer distance that these products will travel, because the actual demand will be diversified. And it will definitely mean, as far as we're concerned, that it's not just the absolute demand of barrels as such, it's actually the longer ton mile that we're going to see as a result of any incremental demand coming on now.
I mean, Mikael, to stay with you for just another second on this, if you look over the last half a dozen years, we've been in that sort of 20 to 25% of all refined product touching the water. If we do have a tough winter, and as you put it, deliveries are needed on a prompt basis, where do you, obviously you mentioned ton miles, but where do you think the amount of product that touches the water could go as a percent of refined product?
Yeah, so I mean, it's probably a bit dangerous to put a certain percentage on, but I think what I would just try to illustrate is that, you know, if you analyze the normal product tanker market or the tanker market in general, you can kind of take this, what we call main routes. And so what you see in a normal market is that you're sourcing gasoline from Europe to United States, etc. And you know, you have certain routes that you can look at. What you see in stressed periods is that it's really from anywhere. I mean, we're talking West Coast, South America, long-term distance into Asia, where you see US West Coast going all the way through to the Western Hemisphere. So I really think it's not really about the absolute numbers alone. It's actually about, people need to imagine that the ton mile goes up dramatically. And what you have in addition to that is, you know, when you start having pressure on certain products, so what will happen is that you're going to have a lot of uncertainty. So what that means is, in a more stable market, you have more predictability of where ships are going. In a market with high prices, volatility, and an abrupt need for products, you will have a lot of options on every ship, which means that none of these vessels are available for the next voyage. So that's an even add-on more. So there's a reason why, when you look back in history, when you look at freight rates, and I think a lot of people are struggling with this, is why does it not go from 15,000 to 16,000 to 17,000? Well, it's because when you have situations like this, you take out basically overnight a huge percentage of available fleet for next positions, and therefore it goes quickly from 15 to 20, 25, and 30 type of thing. That's really the logic behind it.
Thank you. Tony, the next one's for you. Stolt-Nielsen was the first out of the gates with its third quarter numbers, and if you strip out the fish farming and the terminals business, the chemical tanker results were pretty good. So let's assume that wasn't a one-off. What are you seeing in terms of chemical rates? And the second part of that question for you is, how do you see that as a read across for products, if you do?
Mm-hmm. Just to start with, echoing what everybody said so far about the market recovery, we have the same view, that essentially this very tight oil market is, in a sense, on a collision course with the coming winter conditions and the very rapid demand recovery. So, but enough on that. So yeah, chemicals are interesting. I think one big difference is that the chemical sector isn't dealing with the rundown in stocks that the oil market is dealing with. So I think that's one key difference. The other one is that the tanker market tends to be more driven by oil market dynamics and a little bit less by GDP. The chemical tanker market is different. It's the reverse, where it's more tightly correlated to GDP. So where you're not suffering from that drawdown of overhang of inventory, and where you're more tightly correlated to a very, very rapid global economic recovery, you're going to see the results. Our ships are not like Stoltz. They're coated. They trade more on the periphery, but we do trade a lot of chemicals with them. And I would say that if you capital adjust, our chemical tankers are probably $2,000 to $3,000 a day ahead of the MRs.
And Carlos, I'm going to ask you that second part of the question. How do you take the constructive rates out of the chemical tanker business and think about how what that means for the product business?
Yeah, I think, of course, there are linkages between the two sectors, the chemical tanker vessels can transport also refined products, and when their markets are not doing well, they will increasingly look for those cargoes. And so on the margin, they can have a negative effect on our sector when the sector is weak, and vice versa when the sector is strong, that it can have a marginal positive effect for the product tankers. And of course, many product tankers can also transport to a certain extent easy chemicals or veg oil and palm oil, and therefore can benefit potentially from a stronger chemical tanker market. But it's also important to put into perspective that the relative size of the two markets, and the chemical tanker market is much smaller. If you look in deadweight terms, it's around 49 million deadweight tons, whilst the product tanker market is 176 million deadweight tons. So it's 3.6 times larger than the chemical tanker market. So it's usually the other way around. A strong product tanker market might help more the chemical tanker market than the other way around. Unfortunately, just to strike a bit of a sobering tone here, although I'm very positive, and especially relating to the spillover effects of the energy crunch that we are experiencing on our sector, we do depend instead quite a lot on the crude tanker sector. And the crude tanker sector is not doing very well, and it will do better next year. But my understanding is that their fundamentals are not as strong as ours. And so we have seen that in 2008 when, crude tankers were snatching clean cargoes on their maiden voyages, gas oil, transporting them from the east to the west. And of course, there are the LR2s, which can trade both clean and dirty. And we have seen that over the course of the year, the percentage of LR2s trading clean has increased quite a lot, from 50% to 60%. And that creates a drag for the product tanker market. And so it is really important for us that the crude tanker market do well. And in that respect, I would say, that the Fredriksen's purchase of a big stake in Aeronav recently announced is a good sign. He knows what he's doing, and if he's bullish on the sector, it's a good sign for the crude tankers space, and hopefully also for us.
All right, let's go to the supply side for a minute now. The lack of new builds, or the relative lack of new builds, can it last long enough to create a meaningfully positive cycle? And why don't I start with Eddie on this?
Yeah, thanks, Jim. I mean, the supply outlook for product tankers looks promising. The overall order book is about 6%, 6% of the global fleet, and at, let's say, historical low levels. So the new orders are less than the deliveries. And this is because, we've seen, we're in a prolonged depressed rate environment, and that has averted new orders. In addition to that, the new building prices have increased substantially since last year. And I give you an example, an MR2 this year has been quoted by a reputable Korean yard at 41 million, when last year, same shipyard was quoting 36 million. This is for a standard MR, nothing special about it. Now, I'm also, there's developments in the technology. So engine designs, stricter environmental regulations, and of course, the selection of the potential carbon-free fuel. This is a very complicated decision-making. Therefore, many owners have decided not to proceed with placing new buildings. A very encouraging sign that we've seen this year is scrap ratings. And as far as the MR sector is concerned, we've already seen about 30 vessels being scrapped, which is the highest we've seen in 1 year for a long time. So overall, we estimate the net supply growth for new buildings to be approximately 2% annually for the next 2 years. Now, if the global demand growth goes as expected, then the sector could experience a substantial recovery. For a sustainable period, and this is what we need in the product tanker segment.
And Jacob, I'm going to ask you the same question. The relative lack of new buildings, can we create a long enough cycle this time?
Yes, I subscribe to what Eddie just came into, and I think in the medium term, clearly it is teeing up well for us because, as Eddie pointed to, if you're a shipyard right now, you're being overwhelmed by container liners who are really scrambling to get capacity up. And if we take this first half of the year, I think the overall contracting into container was historically high for a 6-month period of $26.5 billion or something, fantastic. And at least for now, the global supply chains are so constrained that the shipyards will continue in this environment to get a lot of phone calls from big players in the liner industry, I'm sure. And that, of course, pushes back any eventual sort of stepping back into the building of product tankers is being postponed. Basically, every day that there's gold and glitter in containerized and in dry. So I think for us, clearly, product tanker vessels, building of that is a low priority. And that's also why the price range that is being quoted is significantly higher today than it was. And it's not because of the underlying markets having pushed up the prices. So I think that this bodes well for the medium term. Obviously, eventually, there's going to be a new dynamic, both in the alternative business for the shipyards and also in our segments. But this could push back an eventual real sort of supply-driven fall on its knee in this market by 3, 4, 5 years.
Okay. This next question, I want you all to pitch in, and I'm going to start with Mikael. But when do you see peak energy? And are the green alternatives a medium-term or a long-term competitor? Mikael, starting with you.
Thank you. Yeah, so I mean, I think if you're going to determine, the peak oil, I don't think it's really for us individually to kind of come up with our guesswork, but I think it's pretty widely recognized that when you look at different international organizations and analysts, that it could be anywhere from the late 20s to even further out, and I think. I don't think there's any doubt where the world is heading, and I think we're all here as well in the shipping industry, very much, preoccupied with trying to adapt our business in terms of how can we improve what we do in terms of our environmental footprint as one thing. When it comes to what we're sailing with, I think we have to be a little bit careful, kind of not to underestimate the time it will take to change some of these massive infrastructure things that need to be changed in this whole green transformation. So, I think our view is that at least the assets we have today, we are super comfortable, to run them as long as need be, and we think oil will be a big part of the complex going forward. So, I think once you reach a peak oil scenario, it's not going to fall off, in our view anyway, off a cliff overnight. It'll be a sunset discussion that will go for many, many years. So I think the clue is really to try to have a competitive business to stay kind of ahead of the pack, if you like. But our view is that at least for the existing assets going forward, that oil will be an important part of the energy complex, and we'll continue to transport it as long as there's a demand for it. And at the same time, for the longer term situation, you need to adapt your business to what would be the future transportation needs. And still I think the jury is out in terms of what kind of products, and in our view anyway, there'll be more than one, will be the future renewable energy used for particularly in the transportation sector. So that's kind of our view on it.
Tony, you studied science better than most back in school. What's your view on the peak energy and the green alternatives?
So I just think make a very important point. Peak oil is not the same as peak product tanker demand. We have secular trends that are ongoing and in fact probably accelerating in terms of where refineries are being built. 30 years ago, 10% of 10% of oil moved was products. Today it's around 35%. So there's a very long-term secular trend that will continue to drive product tanker demand beyond peak oil. When that happens, we're probably into a very different world in terms of regulatory compliance, and then probably the supply side comes under tremendous pressure, and you're really dealing with capital expenditures for new replacement vessels. So the market at that point could be a supply-driven market. So we're going to be going through very, very substantial change in the next 10 years. Part of that will be peak oil. But a big part of it will be the regulatory regime that's eventually imposed on us, which will result in new ships. In terms of demand for green cargoes, we're very focused on what we think of as sustainable cargoes. And part of that will be different types of renewable fuels, which will be moved largely, we think, on product and chemical tankers.
Thank you. Jacob.
Yeah, thanks. Thanks. I think my colleagues have already put it well, but if you take the very short end, then I think there's a lot of talk, fortunately, about the green transition. The fact is probably that, let's say, within the short to medium term, the rebound in economic growth that we are experiencing will outpace any impact from the green transition that is actually taking place, let's say, at least in the coming years. So I think when we're discussing this theme, it's probably something that is closer to the end of this decade or into the next decade. And an example is, obviously, I think we're all hopeful for the world that green alternatives will be taking a larger and larger share of the energy complex as we head into the future jointly. But if we even assume that EVs is probably the sector that is logically first to sort of transform itself from the current energy complex into the passenger cars are electrified. And let's say that 75–80% of all cars globally within the next decade is going to turn into becoming electrical. Then out of the pool of cars in the world, it's still only going to be 20%. So this is a long journey. It's not a short journey in any way. I think the responsibility, as Mikael and Tony also said, is actually on us to still fulfill the role of transporting it, and transporting it, obviously, with the lowest emissions possible, with the lowest CO2 footprint, as we are supplying the world with one of the products that is needed in the value chain. And it's going to then, over time, transform into to a number of different products in addition to the ones we know. But it is so that the services that we have together on this panel and in the broader space of all fossil fuels is actually still very much needed. And I think the energy crunch right now, as we debated a little earlier, is a very good example of that.
Now, Eddie, I know your time is limited, so why don't I have you answer that question, but also just touch base on anything else that you wished I had asked you in the first 35 minutes here.
Jim, I thank you and I apologize for having to leave early. I don't have to add anything. I think it's been very well said by my colleagues. Only thing I can say to the audience is that product market, tanker market has been disappointing for the past year, but the signs look good for the next for the coming months. We really believe that a sustainable recovery is about to happen, and therefore we have strong belief in the market. And again, I thank you very much for inviting me today.
Thank you. Carlos, feel free to touch on the last question, but I also want to jump into day rates and share prices were on balance a little bit stronger in Q3. And what are you seeing in terms of asset prices?
Yeah, I think the last question was covered very well by the other panelists, so not much to add. Just a quick data point to understand of course, the threat from EVs is that the EVs sold last year globally represented 5% of total car sales, but still EVs in circulation today represent only 0.6%. Of course, in the countries, in some countries, this penetration is bigger, the growth is faster, but there are also many other countries which are lagging well behind and will lag well behind in this penetration of EVs. And it's important to remember that the car fleet is going to increase over the course of the next few years, and quite a lot. So I think EVs are a long-term threat. They are not an immediate threat, and there are many other forces which will be overwhelming in the short term. Going on to the next question regarding the asset values and the share prices, I would say that we have seen actually an increase in asset values, especially for young tonnage over the course of this year, which is driven, I would say, partially by the pull effect of the increase in new building prices, which we already mentioned, and the increase in demolition prices. So exerting an upward force both on the front end and the last part of the curve of the price curve for young and old tonnage, but also because of the good fundamentals, near to medium term fundamentals for the industry. So we now see that secondhand tonnage is still at a big discount to new building parity, despite this increase in asset values. And share prices are lagging behind, but they will recover.
Thank you. Jacob, do you have anything to add to day rate, share prices, or asset values, or would you like me to move on to the next?
I think Carlos put it well. We are not in an excited environment on day rates, any of us, whether in crude or product. And as Carlos put well, the replenishment cost of a new vessel has gone up simply because of the nature of the shipbuilding industry, and that leads to that probably on average, older vessel prices have gone slightly down, and for new assets it's gone slightly up. I think that's the general market sentiment right now. Not much more to add.
Okay, listen. The next question: there are clear performance differences amongst the players in this industry. So the first part of this question is, why hasn't there been more consolidation? And the second part of the question is, why is there so much of a fixation on price to NAV? And why don't I start with Mikael?
Thank you. Well, I mean, I think on the first one around consolidation, I think it's probably a combination of a lot of different issues. I mean, there are situations where control is important, right? And where certain shareholders prefer actually to stay in control rather than maybe combining and thereby losing part of that. And that could be also related to exit plans, etc. That has to be planned. There's probably also an element of sometimes of fleet composition and how people see the future and what they would like to combine in that sense. So there could be differences in earnings and performance, but there could be a reason for not consolidating certain platforms. And so I don't think so. I think as far as the industry is concerned, this is something we've seen over years. I don't think consolidation, if you go back in the days, were particular dominating. But I think what we have seen though is actually quite a bit more maybe than what we saw the years before. So I think, but those factors, I think, to me is some of the reasons why things haven't happened. On the other hand, we've also seen that things have happened where certain platforms have found that teaming up is actually going to give you better valuation. And I'm now referring particularly also to the stock listed environment. I think it does make sense when you look at what investors want in terms of scale, size, and particular free float of shares. I do think that there's merit to certain combinations that could give that to shareholders. So these were kind of, at least my observations on that. And your second question was on?
So the first part is why not more consolidation? The second part of the question, why the fixation on priced NAV?
Yeah. So by the way, my final point is I still think we are going to see consolidation as we move forward, and particularly in terms of as we look into a future where the energy complex, as has been talked about here in this panel, will change, and in that context, you actually need, in my view, scale and financial strength to be part of that transformation as you slowly but surely will look for the future in terms of different investments, different types of ships, etc., to adapt to that. I think the price to NAV is probably a legacy in shipping, right? I think we've been talking about this for many, many years. And I think, so part of the reason, and it's something which we have been struggling with as well, I think in Hafnia, we have quite a big revenue stream of third-party business, pool business, last year, 23 million. This year, even in a bad market, 10 million the first 6 months. And yet your pricing is very much linked to NAV, and it doesn't really take that into account. But, I think there's still an element of poor visibility going forward. So NAV is an easier one to put a hook in, as opposed to visibility for a company that is exposed to the spot market going forward. And the large swings that we have seen in certain markets, I think that's probably part of the reason why we're still stuck with the NAV. But it shouldn't be the only factor, in my view anyway, valuing companies per se.
Yeah, and just a very quick add-on to that, with your third party commercial management business, has the market ever given you, in your view, the extra credit for that above the value of your shipping business?
No, I don't think so. Not in the reflection of the share price. So I think so far it has not been properly reflected. But again, that's also a combination of, you just have to continue, I think, to push and reflect that. And I think in poor markets, quite frankly, these are sometimes tougher ones to sell, right? But over a 10-year period as we are now, you should begin to see those valuations reflected in the overall valuation of your stock.
Tony, I'm coming to your next. Why hasn't there been more consolidation?
Good question. So a couple observations. One is that so far, virtually all the consolidation has been driven largely by private equity exits, and a little bit by financial distress. The second observation is that scale does matter. We're in a highly fragmented business. So the largest players have maybe 5% of the market, which is very small. And if you add the top 10, they probably account for certainly maybe about 20%. So so the real impact of fragmentation is the other 80%, where you've got people with 2, 3, 4, 5 ships trading without sufficient information, and without discipline, et cetera. And so I think that's where consolidation could help. So I think that's maybe a point for discussion. The advantage of the business we're in is that it's a trade. It's highly fragmented, and it's a trading business. So it means that that if you have a really motivated team where they're well aligned with shareholders, they can actually trade quite well without you don't have to be the largest to compete with the largest companies. So it's a complicated topic. When it comes to price to NAV, I think in one sense we should be very happy that we get value based on price to NAV, because it's really all about your returns on capital versus your cost of capital. And the problem is, if you have an increment but you're still below your cost of capital, you're still below your cost of capital, right? So I think the game is to transform business models so that your returns are exceeding your cost of capital. That's business 101. that's, I'm sure we're all trying to figure that out very privately on a long-term basis.
Jacob, do you have anything to add to the, as quickly as you can, either the price to NAV or lack of consolidation story?
I think we've actually seen some consolidation in the sector over the last couple of years. I understand that it's not everybody that's been involved, but there has actually been consolidation taking place. And I think I agree with Mikael that there will be more. It's not only driven by market knowledge and a better understanding of what the dynamics in the freight market is. I think it is clearly also driven by increasing scale benefits on financing, regulatory, digitalization, ESG, other elements where you can say, yes, you can have, as Tony say, a nimble trading organization, but there's going to be some requirements, either regulatory or from investors and banks, that will heighten the burden on organization and therefore also the scale benefits. So I think that's why we've seen some activity and it is teeing up for even more.
All right, we're down to the last question. You each have a minute or less to answer it. I'm going to start with Carlos. What are you factually doing to improve your ESG profile? The clock is running.
No, well, the main initiative for us was the new building program that we undertook starting in 2012 and with vessels delivered between 14 and 19, and where we invested over $750 million in eco vessels, which today represent 75% of our own and bareboat fleet. Of course, we also invest a lot in the education of our employees, both on shore and on board our vessels. And we are involved in a technical school, the Fondazione Caboto in Gaeta, where we train technical staff. We are involved with the National Maritime College of Ireland. We have been involved with 6 years with them, and we offer the opportunity for up to 18 cadets to board one of our vessels.
You're down to 10 seconds. I'm gonna.
And of course, I think that we are a very strong player in terms of the management of our vessels, the safety, the statistics, the vetting, inspections, the control. So I think that the port state control statistics, so that of course is also a differentiator. It's part of our ESG push.
Thank you. Tony, next.
We rather not speak about ESG, but rather progress. But if you go through the letters, in terms of the E, we have our energy transition plan, which is transition technologies, transition projects, and sustainable cargoes. When it comes to the S, we have a high degree of diversity in the company already. More than 50% of our staff is female. We've got 14 nationalities ashore, and we've got a very vibrant cadet program. In terms of the G, we're the top foreign private issuer on the Weber governance scorecard.
Excellent. Mikael.
Thank you. Yeah, so I think when we look at the on the environmental side, so we've been focusing on investing in digital solutions with smart ships and Alpha Ori, which is basically about making sure that you have all the data available on your ships, which allows you to actually optimize on how you run them, both in terms of what I call voyage-related basis, but also in terms of an overall predictive maintenance program. So having reliable data across the board for all of your maritime operations has been part of it. We're focusing quite a bit on blended fuels as well, which we think will be an important transition. Working with ARC Fuels about turning, coal waste into being able to blend into oil. So that's another part. We think the blended fuel oil in general is an important part for the transition. When it comes to the actual ESG side and reporting, we partnered up with someone called Diginex, which is really all about trying to develop for the maritime industry a proper standardized reporting structure, digital, that allows everyone to report to whatever standard is needed out there, and where investors can then measure across industries how you've been doing in terms of your performance and targets. And I think on the social side, as Tony also mentioned, strict targets on diversity and inclusion, participating in charters around diversity and inclusion, and having clear targets for what to achieve.
Thank you. And Jacob, you've got the last 30 seconds.
Well, thanks a lot. And ESG is obviously becoming part of our lingo every day. And in TORM, what we do about ESG is actually making it actionable now. And I think it's been said here, on an integrated platform, like for instance ours, we can really make a difference, creating the greener future, not tomorrow, but today, making sure that we do our part of reducing emissions already now, having diversity as top of our list. And also, again, if we look at the G that on governance, we are also in the top quartile in the Weber famous rooster. So I think it's all of the above.
Thank you very much. I learned something today. I hope the audience did as well. And I'll turn it over to Capital Link. Thank you all.
Well, let me tell you, I'm getting a PhD every day listening to this wonderful panel. So I'm absolutely grateful to all of you for a great discussion. Thank you very, very much. Thank you.
Thanks for having us.
Everyone.